Good afternoon and welcome to Real Wealth Network's weekly webinar. This might be my favorite one so far. I'm very excited to have the Executive Vice President of RealtyTrac. As I mentioned earlier, that's a pretty big deal. Rick Sharga is here with us to share the data that he's been tracking and what it kind of means for 2021 and kind of a look back, and what it means, even more importantly, for 2022 as we move forward. There are, this real estate market, real estate is always exciting because it's ever changing. And we do have some changes possibly coming in 2022 that people need to be aware of that might affect the decisions that you make. So I couldn't think of anyone better to join me here today for this year end and kind of forecast for 21 than Rick Sharga. So Rick, I'm just so happy you could be here today.
It is always my pleasure to do these with you, Kathy. You're one of my favorite people in the industry, and your crew is lucky to have you as their leader.
Thank you so much. And I know you decided to do this today so that you wouldn't have to carry any more boxes from the attic to do any more decorating for Christmas. If anybody follows you on Facebook, they'll know what I'm talking about.
Yeah, watch for the upcoming Facebook posts on the army of nutcrackers protecting our fireplace.
And I think everyone watching should probably send you some more because you're only at 60 now. Okay.
We'll need a bigger house and a bigger fireplace, but everything's possible.
Well, I asked you today to bring some slides. For me, it's really helpful to see the visual. I'm more of a visual learner. So I really appreciate you sharing your, I don't even know how many hours it would have taken to put all this together, but thank you for sharing it with me and with our audience at Real Wealth. So with that, I'll hand it over to you.
Well, thank you, ma'am. And thank you for inviting me to be here today. I'm going to go through a whole bunch really quickly, and then Kathy, you and I can chat about it some more and field some questions from any of the viewers. We're going to take a look at what transpired in 21, what we think might be happening in 22. We'll start with a review of the economy, which of course is the baseline for everything that happens in real estate. Do a quick recap of the housing market, take a look at what's going on in default. Specifically when it comes to the mortgage forbearance program that was part of the government's CARES Act that was put in place when the pandemic was declared. And I know that a lot of real estate investors are very interested in foreclosure properties. So we'll talk a little bit about what we think at RealtyTrac might be coming in the way of foreclosures. A lot of discussion, a lot of coverage in the press about the coming wave of foreclosures and evictions. And spoiler alert, we just don't see that happening anytime soon. So we'll go through that, and then you and I, as I said, we'll chat a little bit. Sound like a plan?
It sounds great. I'm just saying. This is important information because there's so much misinformation. My daughter's looking at buying a house that has gone up probably $300,000 since the time she last looked at it. And the inspector was like, this is a crazy market. It's about to crash. It's 2008 all over again. And I was like, you might want to tune in to my webinar tomorrow. So I'm sure those comments are
2020. I've heard them all. Every time I post something on LinkedIn or Twitter, I get responses from people telling me I'm insane and just wait, the bubble's going to burst, the market's going to crash, and then I have people saying that, well, weren't you one of the guys that was telling us there wasn't a problem last time? And I thought, no, you clearly were following the wrong person, because I was getting lambasted for saying there was a problem coming. So you can't please everybody. So we'll what's the old song from Ricky Nelson? You can't please everyone, so you got to please yourself. So we'll try and keep things on the up and up. And hey, I've been wrong before. I've been calling for interest rates and mortgages to go up for probably 8 years in a row. I figure even a broken clock is right once or twice a day. So eventually we're going to get these things right. But here's our best view on what's been happening and what we think is going to happen, and that's what we're happy to share. A lot of people refer to what's been going on in the economy as a roller coaster. I tend to look at it more as a bungee jump. Roller coasters, you kind of go up and down, but and around, and it takes a longer time. When the pandemic was declared back in February of 2020, we had the biggest single drop in GDP in US history, bigger than the Great Recession, I believe bigger than the Great Depression. It was a 31% quarter over quarter drop in the second quarter of 2020. The good news is that it had been anticipated. The US economy is built 70% on consumer spending, and the government between the federal government, state and local governments effectively shut almost everything down. So consumers had a hard time buying anything, including, paper towels and toilet paper. And so it wasn't a huge shock that we saw things plummet. And the government put a lot of stimulus into the economy to try and prevent the recession from lingering or even turning into a depression. And those efforts were largely very successful because we saw the GDP bounced back by 34% the following quarter. For those of you like me who are sometimes challenged with basic math, a 31% drop followed by a 34% increase doesn't get you back to where you were, but it certainly helps. And the other good news is that the economy has recovered in all of the subsequent quarters. So we're back above where we were prior to the drop. We're not probably where we would have been if we hadn't had the pandemic, but the recovery has been nothing short of spectacular. To put this in context, the Great Recession, which is what a lot of people try and compare the current cycle to, took 10 full years to get back to where we were when the recession started. So depending on who you like as your historian, it was either the longest sustained period of US economic growth, which is true, or it was the longest it took the US in history to recover from a recession, which is also true. In this case, we've recovered from one of the deepest recessions in history in 18 months, which is just phenomenal. The other part of that is that we lost about 22 million jobs virtually overnight. So the unemployment rate went from 3.5%, the lowest it had been in 50 years. We had record low unemployment for Black workers, for Hispanic workers. We had the most women in the workplace ever. The economy was hitting on all cylinders. And then overnight, we lost 22 million jobs. The unemployment rate skyrocketed to about 15%, but is now down actually below 4.2%. And we're in a very unusual economic state in that we have more job openings than we have people collecting unemployment. That almost never happens. So there are a number of reasons, a number of theories as to why more people aren't taking these jobs. One of the things I will tell you that I think has been underreported in the press when they're talking about jobs numbers. The last jobs numbers that came out looked like a huge miss. The estimate had been for about 589,000 new jobs. The number came in at 210,000. But if you dug into those numbers a little bit, you realize those numbers that are reported are corporate payroll jobs. What we saw kind of behind the numbers was that there were about 400,000 new businesses started during the same period. And so people talk about the Great Resignation in October, about 4.5 million people quit their jobs. That's not a sign of a weak economy. That's actually a sign of a strong economy. When a lot of people resign, aren't laid off or fired, but quit, they're either moving on to a better job or they're doing something like we saw recently where they're creating new businesses and therefore creating new jobs. We'll probably be back down to pre-pandemic unemployment numbers sometime next year. The one thing that hasn't come back is labor force participation. We have fewer people working and looking for jobs than we did prior to the pandemic. How much of that is permanent? How much of that is temporary? We don't know yet, but a big jump in the number of folks 55 and older who were working, who are no longer working and no longer looking. So we're not sure if the pandemic really caused a lot of early retirements as people kind of rethought their priorities. But across the board, the only industry that hasn't fully recovered at this point is the service industries. And those industries were the ones that really got hammered with the job losses. Retail, restaurants, travel, tourism, hospitality, entertainment. And one of the reasons the housing market didn't take a beating is because those industries are largely populated with people who are renters rather than homeowners, and in a lot of cases aren't even close to being homeowners. So a lot of the damage was done in the employment of of renters in these service industries. And in fact, the pandemic had the opposite effect among current homeowners or people that could afford to buy a home, in that it actually accelerated some trends that drove demand. The one lingering after effect of this recession is inflation. It's running between 5.5% and 6% right now, biggest jump we've seen in decades. Part of it is caused by the supply chain disruption that you probably read about, and I'm coming to you live from ground zero of supply chain disruption. If you look out at the Long Beach Harbor or LA Harbor, you see miles and miles of container ships backed up. I don't know if this is true or not. Somebody told me if we had trucks running 24/7, it would take almost 18 months to empty everything that's sitting out there. So it's just, it's a bit of a problem, and it's a problem that the Federal Reserve Chairman, Jerome Powell, has recently shifted gears on and said it's probably not transitory, it is probably persistent. Not a surprise when the government injects $7 trillion into the economy in 18 months. But if you're looking for a potential downside to what's going on economically and across the country, it's the impact inflation can have. It can raise interest rates. It can make it harder for people to be able to afford homes, afford rent. It will increase the cost of supplies for anybody who's in building or construction. And it could also lead inadvertently to a recession. If you look back at most of the recessions since World War II, the Federal Reserve has had their thumbprints all over them. And I liken it to being on a slippery road driving. And you can either tap on the brakes slowly and gently to come to a controlled stop, or you can slam on the brakes and you wind up skidding into a ditch. And that's unfortunately been the track record the Fed has had for decades. When they're trying to slow down runaway inflation or an overheating economy, they have a tendency to overcorrect. And if they do that, that could lead to a recession. Probably not a long, severe one, but could lead to a recession. This Fed group seems to be pretty cautious in what they do, so we may not have that. But I do get asked the question a lot, like what could go wrong, and that's something that could go wrong. More specifically to housing, I like to tell the story that in May of 2020, I was doing a webinar with a very well-known real estate analyst. I won't tell you who he was because I like him. And what I'm about to tell you is perfectly logical at the time. But in May of 2020, he very confidently predicted that home sales would be off by 40 or 50% by the time the year ended. And at the time, it was a perfectly logical thing to forecast, because we pretty much lost the spring selling season, which is, as everybody on today's webinar knows, is probably the most critical time in the housing market. What happened instead is the rest of the year went crazy, and we saw pent-up demand. We saw increasing numbers of millennials enter the market. We saw people move from the urban areas where they were renting to become suburban homeowners, and home sales were up a little bit 2020 compared to 2019. In the end of this year, we'll probably see about 6.1 million existing homes sold, which is another year-over-year increase, and we'll probably see 800,000 new homes sold. And both of those cases, despite record low inventory levels. If you look at new homes in particular, the number of new homes that are already built and available for sale is less than a half a month's supply. There's literally nothing on the market, and the builders had been selling a lot of properties that were under construction, or in some cases where they hadn't even broken ground yet. They've slowed that down in the second half of the year because of the supply chain disruption. On the one hand, they're not sure they can complete the property construction in time, because it's taking them 6 months to get windows and 9 months to get roofing supplies and a year to get appliances. And on the other hand, they're also concerned about having to go back to the buyer and say, hey, my materials costs just went up 40, 50, 60%. We're going to have to renegotiate. So instead of doing that, they've slowed down. But we would have sold more existing homes, more new homes, if there were more of them to sell. And that's something that probably is going to take a few years to resolve, in case anybody's wondering. We do a quarterly investor sentiment survey at RealtyTrac, and lack of inventory has been the #1 problem cited by investors now for 3 consecutive quarters, and also the one they anticipate being a problem in the coming year. We've seen strong demand that's driven by millennials. I mentioned that the largest group of millennials, which is the largest generation in U.S. history, is rapidly becoming of age. They're at prime home buying age now and will be for the next 2 to 3 years. So you're talking about millions of people coming onto the market. We've seen demand driven by low interest rates, 2.5%, 3% mortgage rates, especially during a cycle where inflation is at 5.5%. That means you're basically making money every time you make a mortgage payment, which is just crazy. But in our parent company, Adam Data Solutions, puts out a quarterly report on affordability, and what we found is that more than half of the markets we measure, it's actually cheaper to make a monthly mortgage payment than it is to make the average rental payment in those markets. That's the effect that those low interest rates have had. And then the other driver of demand has been the pandemic itself, which, as I mentioned, has accelerated a trend we were already starting to see, where urban renters were becoming suburban homeowners, and in some cases suburban renters, but they're moving out of the city to the suburbs, the far suburbs, even just about rural areas, as they're looking for more space between their neighbors, as they're looking for bigger homes where they can have a home office, and candidly, where they can now work from home and don't have to worry about being close to the city center. So we've seen home prices go up about 18 to 20% year over year, depending on what part of the country you're in and whose numbers you believe. We don't see demand slowing down next year, but I do believe we're approaching what I call an affordability wall. Some of the higher priced markets that we track, particularly coastal California, the Pacific Northwest, even some markets where we've seen unusually high price appreciation, Austin, Dallas, Fort Worth, to a lesser extent, Boise, Idaho. We're starting to see list price reductions. We're starting to see some corrections at the high end of the market. So I don't think we're in bubble territory yet. We keep going up 18 to 20%. We'll get there soon enough. But I would not be surprised to see prices drop in certain markets at certain tiers by maybe 5 to 10% over the course of next year, particularly if interest rates go up, as most of us expect them to do. Everybody is somewhere between 3.5% and 4% by the end of next year for a 30-year fixed rate loan. Our estimation is about 3.25% by July, 3.75% by the end of the year. And so the other reality is that people still prefer to live indoors. As it turns out, apartment vacancies are historically low. There's over 98% occupancy rate across the country. Asking rents for new tenants is up 12% from a year ago. That doesn't reflect renewals. That's new asking price for people moving into vacant apartments. That's a market where the rent increases are usually between 1% and 5%. So 12% is just way off the charts. But Kathy, I'd be curious how those price numbers in terms of home price appreciation and what you're seeing in terms of vacancy rates and rental prices in the single family market, particularly with your portfolios, compares to what I'm trotting out here. You don't have to tell us if you don't want to.
I'm muted. Okay. It's like everything. Every market is so different. If we're talking about Boise, Idaho, I would not have anticipated the price gains that have been seen there. So I've been off too. I did not anticipate that certain multifamily would be double the price, would be trading for twice what it did 18 months ago. So there's been a huge run up. And there will be areas that slow down simply because they moved so fast. But then there's other areas that haven't and that are still pretty affordable. And that would be the areas that we're in and we always have been. It's the markets that still make sense, where it's still affordable, where it's just been undervalued for a long time, comparatively speaking, not for the area itself, but compared to the rest of the country. Like in 2005, when we were buying in Rockwall, Texas for $120,000 for a brand new home, and when we would maybe pay a little more to get the winning bid, which there weren't really bids at that time. Like we were the only, well, actually there were a lot of first time buyers at the time. We just would go a few $1,000s over asking price and people would be like, what are you doing? Because it was unprecedented for the area. But for us, it was still so cheap. So I think that exists today still, where people coming from, and if you take the Florida market or anywhere in the Southeast, you've got people moving from the Northeast. It's so cheap. It's still cheap. It could double in price and still be cheap. Not cheap for the locals, but depending on who's moving there. Same with Nevada, Arizona, and even the Northwest. When you've got California money moving to those areas, it's really expensive, historically speaking, for the area, for the locals there, but again, not for the people moving in. So that's what we're still following, is those demographic trends. And I think if we're still able to buy brand new homes in Florida for $200,000 or even $250,000 or $300,000, which is more than we've spent, it's still a bargain, in my opinion.
Yeah, I'm spot on. The trend we're seeing is people moving from more expensive to less expensive markets, and that almost singularly is what drove Boise prices up this year. You saw a lot of flight from particularly the Bay Area of California, but even some markets in the Pacific Northwest where people would cash out their house that they were living in, use the cash to come into markets like Boise. Another market was St. George, Utah, saw phenomenal growth. And these have become sort of satellite tech hubs. So there's, the Boise market, you have the university kind of atmosphere because of Boise State being there. You have good healthcare and medical facilities. You have a little bit of a kind of cool urban environment, maybe not New York, but not Oshkosh either. And people didn't really care if they were paying 30-40% over market, because it was still a bargain compared to where they moved from. And they were able to buy it with cash and still put money in the bank. So it was, I again, to your point, not great news for the local people trying to buy, great news for the local people who already owned a home because their equity went through the roof. But it'll be interesting to see as the market sort of settles down in the next year or two, how well those prices hold. Again, if you're a buyer who came in from California, paid cash, less relevant because it's not like you're going to default on a loan because your property value goes down. But I do expect a little bit of market volatility as we get through some of these things. That, by the way, is one of the reasons you have to take the median prices that are reported by the National Association of Realtors and others with a grain of salt. You're looking at markets like Boise and St. George, Utah, some of the markets in Florida that Kathy probably was referring to, where you're having unusual price spikes, which is driving the medians up. The other thing is there's virtually no inventory available at the entry level. And if you remember sixth grade math, a median is the exact midpoint between the high end and the low end. And if there's nothing at the low end, or the low end keeps moving up, it moves your median up. Doesn't mean that every house is up 18 to 20%, but it does mean that median, which is just one of the measures we use, is going up pretty significantly. But we see continued strength in the housing market as we go into 2022. No real storm clouds on the horizon, barring some unforeseen catastrophe like we had a couple of years ago.
I do have a question though, because my daughter is looking, she's in escrow right now. It takes a lot to win the bid, and she's in, just in the Los Angeles area. And it's $1 million house. She's 29 years old, but that's cheap in the area that she's buying in.
Yep.
In the actual loan she's able to qualify for, which is amazing. And the payment is really not much more than she's been paying in rent. She was able to sell her house in Chico, use that down payment. I'm so proud of her. But there is this lingering thought of, are we, is this one of those areas that if interest rates go up, will be more affected? And the only reason I'm not so concerned about it is because she's got good income. She's got her own business and it's just exploding. And she'll be there for a long time. But you also don't want to buy, it's like, should she wait 6 months? Of course, she's already in contract. But what are your thoughts about high-priced markets like California when interest rates go up?
Well, the knee-jerk reaction everybody has is interest rates go up and prices go down. That's actually, if you look at it historically, that's actually not true. Typically what happens is if the other market conditions remain strong, your home prices don't necessarily go down, but the appreciation rate goes down. So prices maybe flatline or appreciate more slowly. But everybody's still a little spooked by what happened from 2008 to 2012, and that's happened exactly once in history, where we've had a national drop of 35-40% in home values. You also talked about a couple other factors that mitigate risk as a homeowner. If your time horizon isn't short term, you can usually weather a short-term drop in home prices because, again, if you look at things historically over time, home prices do go back up. Even coming out of that Great Recession where we had that huge drop, we're now well above the nominal home price peak that we hit back in 2006. So if your time horizon is long enough, that protects you. And if you don't have an adjustable rate loan, that also protects you. One of the reasons we had the problems last time is we had a higher than normal percentage of adjustable rate loans. And not only were they adjustable rate loans, they were adjustable rate loans where the only way the borrower could qualify for the loan was with a teaser rate. And if you were a borrower at a 2% rate going to 4%, I'll go back to that basic math comment I made earlier. A lot of people thought, oh, that's only a 2% increase. No, that's a 100% increase. Yeah. And that's going to have a pretty significant impact on your monthly payments. So a lot of people just couldn't afford those payments when they reset. And that was when interest rates were at 6 or 7%. So I don't see interest rates jumping up that high. We don't have the overhang of risk that we had for a homeowner or an investor with a rental property. You might have to extend your time horizon a little bit if prices do dip until they recover, and every market's going to be a little bit different. But nobody who I talk to, none of the economists, none of the analysts that I follow or talk to is anticipating a wholesale drop-off in prices, even if interest rates do go up.
Okay, good.
Now, they've all been wrong before. But that's why they call economics the dismal science. But no, again, demand looks like it's going to be strong for at least a few more years, even as interest rates go up, even with inflation being a little higher than everybody would like. Doesn't feel like we're in bubble territory. Does feel like some people are extending themselves to get into properties, but as long as that demand is there and outpaces supply, there's usually going to be a decent exit. That's, by the way, what we're seeing in the good segue in the area of default. We did see a spike in delinquency rates, artificially inflated by two things, really. The most obvious one is the CARES Act forbearance program. So government basically told mortgage servicers, if any of your borrowers reaches out and says, I've been affected by COVID, you're supposed to give them forbearance. And 6 months to start, another 6 months if they need it. And then the Biden administration came in and extended that by another 6 months. Once you've missed 3 monthly payments, even if you're in forbearance, the industry reports your loan is seriously delinquent. You're not getting reported to the credit bureaus as somebody who's missing payments, but your loan is counted inside the industry as being seriously delinquent. So we saw those numbers spike up pretty significantly. I'll show you a chart in a minute. But the bottom line is that the Forbearance Act has worked exactly as it was intended to. I personally believe that it's prevented 4 to 5 million unnecessary foreclosures, and by that I mean foreclosures that wouldn't have happened if we hadn't had COVID-19. And I'll show you some numbers as just to kind of put those things in context and tell you how I came up with that. But it is probably the single best example in the 20-some years I've been in the industry that I've ever seen of the government and the mortgage industry working together to affect a positive outcome. Think about what the servicers had to face when this program was enacted. They were issued orders from the federal government to enable forbearance. It was a different kind of forbearance than they'd ever done before. Usually if you forbear some payments, when that forbearance period is over, a lump sum is due back to the lender. Not this time. So they were given all these new marching orders without a whole lot of instructions on how to do it, and they were given them precisely at a time when everything was being shut down. So not only do you have a brand new program you have to implement overnight, but you have to do it with your workforce suddenly working from home. And the fact that there weren't more problems implementing this, and that it's been so successful, is just nothing short of remarkable. Foreclosures today are at historically low levels. I'll show you just how far. But keep in mind that we've now seen August, September, and October, 3 consecutive months of double-digit increases on a year-over-year basis. But the number of foreclosures that had been in process was so small, we're still running about 60% below where we were in 2019. And even 2019 was a low year for foreclosures. So our best guess at RealtyTrac is we're not back to even 2019 levels, probably until late in 2022. And the CFPB has put, enhanced servicing guidelines in place through the end of the year, which make it very, very difficult for servicers to foreclose or begin foreclosure proceedings on anybody who wasn't in foreclosure prior to the moratorium, where there's not a vacant or abandoned property, or where the borrower simply doesn't qualify for any of the loss mitigation programs that are available. The servicers I've talked to are very reluctant to pursue foreclosures on that latter category because they know that the new regime at the CFPB is really kind of enforcement oriented rather than guidance oriented. And they're afraid if they get too many complaints, they're going to put themselves right in the bullseye of the CFPB for fines or other problems. I mentioned serious delinquency rate spiked. So that's the yellow bar on this chart. And this is from the MBA, their quarterly delinquency report. And you can see that quarter over quarter delinquency rates have fallen since that spike. And if you look at Fannie Mae, Freddie Mac, OCC, FHA, VA numbers, they've actually gone down month over month since the peak in early 2020. The yellow area is inflated for two reasons. One is there were a lot of borrowers who were in foreclosure who were then put in the moratorium, or who were on the brink of going into foreclosure who were put in the moratorium. So typically we'd see a little bit less yellow and a little bit more red. I mentioned foreclosures were at an all-time low. So that's one of the reasons the yellow bar looks bigger. And the other, as I mentioned earlier, is the people in forbearance who technically aren't delinquent are counted in these numbers. And so those numbers of seriously delinquent loans are not going to behave the way they did back in 2008, 2009, 2010. And if you look at the new delinquencies, the 30-day delinquencies, those numbers, according to the MBA, are the lowest they've been since they started tracking mortgage delinquencies in the 1970s. So wow. The loan performance for new borrowers is just phenomenal.
Well, they've had, I'm sure you have slides on it, but some of the highest credit scores, down payments, difficult loans, strict loans.
I do have slides on it, but not in today's deck. Okay. But you're right. It was really difficult to qualify for a loan unless you're a pristine borrower. And one of the things that again doesn't get written about too much is a lot of the people who are buying these really expensive inflated price homes are doing so by putting large down payments based on the equity they had in their previous high-priced inflated homes. So it's not like 2008 where you had a lot of people getting 0% down loans with a 2% teaser rate on overpriced houses. These are people with good paying jobs who are making large down payments.
Wow. Yeah. Yeah. I mean, so it was very confusing. And for most people, you can see why people would be confused about what's going on, because Black Knight, I think it was Black Knight, it had the headline news, 5 million people delinquent, it's going to be the biggest foreclosure crisis, maybe even bigger. I kept hearing that 2008, and I'm like, yeah, but Rick Sharga is saying something else. So, were they just like, was it just a headline thing, or?
I'd like to believe that reputable sources like Black Knight, and they have a lot of very good data, weren't doing that for the sake of generating headlines. I'm hoping that's the case. I've also seen certain reporters taking half-baked information from housing advocates and consumer advocacy groups who have been predicting, massive foreclosures and massive evictions ever since the pandemic started. And the math never made sense with what they were saying. But, bad news sells papers. And that's kind of, I'm afraid, what we've had to deal with. To your point, I'm not tooting my own horn here, but I probably was one of the first people to come out and say, I don't see this being a big problem like everybody
Yeah.
else does, because the market conditions were so different, because the government and the industry were so actively trying to avoid it, because we were working on keeping people out of default compared to last time, which is once people defaulted, we were trying to fix it. And that's much more difficult to do from a servicing environment than it is if you can keep people from defaulting in the first place. The other thing people forgot was that the underlying economy was great. It was very strong.
Mm-hmm.
The last time we went into one of these cycles, the economy was really what drove us into the ditch. So, again, this kind of solution probably wouldn't have worked 10 years ago because jobs weren't coming back. And the jobs that were coming back were temporary jobs or contract jobs or part-time jobs. So people weren't able to recover financially, but the people who needed to maintain their home prices or their home payments were able to get back to work remarkably quickly. And in fact, I know this hasn't been the case with your portfolio personally, because we've talked about it, but rental payments have been more delinquent and delinquent for longer during this crisis than mortgage payments have. So it really was a tale of two worlds when it came to how this crisis unfolded. Um, but if you just looked at the raw numbers, there was an economist on the East Coast. I like to make fun of him. He keeps getting quoted, and he's almost always wrong. Almost. I don't know why they keep quoting him, other than just
Have I had him on the show? I hope not.
I don't. We'll talk about that offline. I don't want to do
Okay.
that in front of a lot of people, but probably not.
Okay.
But he was predicting that 25 to 35% of borrowers would enter the forbearance program. When I saw that, I felt good because I knew that it wouldn't be nearly that bad. But what I also realized is if he happened to be right this time, it would have bankrupted the lending industry. There's no way a servicer can support a book of business where 35% of the people aren't making payments. What most people don't realize is even if you're not making your payments, your servicer is required to keep fronting that payment to the note holder. And if 35% of people are allowed to not make payments for a year or 18 months, servicers are going to go bankrupt. If there's nobody to service the loan, nobody's going to make loans. The domino effect of that would have been catastrophic. And fortunately, my favorite economist was wrong yet again. One of my actual favorite economists, Mike Fratantoni from the MBA, shared this with me. And it really is a kind of compelling case study. If you look at it, unemployment rates do have a tendency to drive delinquency rates. And in a normal cycle, you can draw a pretty good dotted line from unemployment rates to delinquency rates to foreclosure rates. Couldn't really do that last cycle because foreclosure rates ran ahead of unemployment rates during the worst of the crisis. But this time, look at how the unemployment rate spiked and look at how the delinquency rate spiked with it. But they've really come down in tandem. And this was a little dated, so I mentioned we're under 4.2% unemployment, and those delinquency rates again keep improving as the employment picture improves. This is what I wanted to show you about the forbearance program. There's a couple slides here that kind of spell out what I was talking about. At the peak of the program, about 8, and look at the yellow line here because that's all loans. About 8%, a little over 8% of borrowers were in forbearance, and that was about 4.4 million borrowers in all. The numbers have come down almost every week consecutively since then, to where today we're down right around 2% of all active loans, about 1 million loans. During the course of the program, about 8 million people have entered forbearance. That means that 7 million people have exited. And I mentioned to you a couple slides ago that delinquency rates have gone down every month for over a year. So I would submit that if these people were leaving forbearance and were likely to go into foreclosure, we would have seen delinquency rates go up rather than down over the last 12 months. But in fact, that's not what we're seeing. And one of the reasons that the gray line here, which is loans that are in private portfolios, in other words, not government backed, those servicers and lenders have bought back some of the loans from the Ginnie Mae portfolio, which is the blue line. And they've done that when the loans go 90 days delinquent. That's a clause in their contracts. They're allowed to do that. That actually helps them save money on servicing the loan when they do that. So that's one of the reasons that that particular category looks a little higher than the others. And that portfolio tends to be things like FHA loans, VA loans, USDA loans, non-conforming loans. I will say to people who are with us today that if you're looking for areas of potential vulnerability, the FHA portfolio is what I have my eye on. So if you happen to be in a market, Atlanta, Chicago, Tampa, Houston, San Antonio, Riverside, San Bernardino, Philadelphia, that has a high percentage of FHA loans and a relatively high percentage of those loans are delinquent, that might be a market to take a look at for those kinds of investment opportunities, because FHA borrowers, not universally, but typically have less equity because they made a lower down payment. They have lower cash reserves. They have a higher debt load. So if they do find themselves in financial trouble, they have a little bit less wiggle room than other borrowers. So if I were going to be saying, take a look here for potential problems, that's probably somewhere I would take a look. This is a really, to me, interesting chart. It shows what happened to people as they were leaving the forbearance program, or what, I guess, what bucket you'd put them into. Almost 21% never missed a payment. So they were in forbearance, didn't have to make mortgage payments, but never missed one. So these were people who probably entered just in case their finances took a hit during COVID, but wound up not needing the forbearance at all. Or they were, candidly, people who saw a government program that would allow them to do something else with $2,000 to $3,000 a month and just thought they'd rather do that than pay the loan, but instead opted to continue making the payments. So surprisingly strong cohort in this program. About 12% had their loans reinstated, and what that means is they opted to make that full payment of whatever payments they had missed, and had the loan fully reinstated and just continued making payments after that. About 30% entered into some sort of repayment plan, either customized or a deferral program. And this is where the program is very different from previous forbearance programs, and one of the reasons we were able to prevent a lot of foreclosures. Imagine you're a stressed borrower missing a year's worth of payments, and on day 366, having to cut a check to the servicer for all 12 months of missed payments. We would have had a flood of foreclosures, no questions asked. The government's deferral program, though, lets you take all those missed payments and tack them onto the end of the loan. So if you're in year 5 of a 30-year fixed rate loan, you don't have to worry about those missed payments for another 25 years, by which point you'll probably long be gone from that property. If you have an account with escrow where your taxes and insurance are also part of the mortgage payment, those missed payments can also be tacked at the end. So that's saved a lot of borrowers. A growing number, and this number will continue to get bigger, I believe, have entered into a modified loan or some sort of combination modified loan, partial deferral, something like that. But servicers have a lot of tools at their disposal and a lot of experience coming through the last cycle at how to work with borrowers who are in some stage of distress and modifying those loans. The CFPB has stipulated that no loan modification can be a payment higher than what the original payment was. That sounds like common sense, but during the last crisis, a lot of servicers, believe it or not, would modify a loan so they could check off a box that they modified the loan as they were instructed to do, but the payment went from $1,200 a month to $1,500 a month. And surprise, surprise, the modification failed. So the CFPB, I guess, felt the need to stipulate, hey, if you modify the loan, lower payment, not higher payment. 7% paid the loan off, typically by selling the house or refinancing. And another 17% exited without one of these plans in place. But the MBA tells us that about half of the time they were still in the process of working out a loan mod, and about the other half of the time they wound up cycling back into the forbearance program. You could categorize those folks as the most vulnerable because they exited without a plan, but so far they really haven't been defaulting or going delinquent in large numbers. Less than 1%, 0.58%, have left by default, deed in lieu, or short sale. So this program has been just extraordinary. And this is a new chart. I'm not sure if they've even published it yet, So you may be getting a sneak preview here, but if you look at the right-hand column, and I apologize, I know this is an eye test. This shows how many of the borrowers that have exited forbearance have continued to make on-time payments. And the total number is somewhere in the vicinity of 85%. If you go back to the last crisis and you take a look at modified loans, deferred payments, reinstatements, whatever, if you got to 50% success rate, you were doing really, really well. So 85% successful is just extraordinary. And this, by the way, doesn't mean they're going to foreclose if they've missed a loan. It just means they're delinquent. I had the chance to speak to the gentleman who runs the default business for the Veterans Administration. He's expecting virtually no defaults from their book of business. They've had virtually none so far as people have exited the program, and he believes they'll continue to be successful doing what they need to do to keep those loans from defaulting. Similarly, I talked to somebody from Fannie Mae who told me that among their borrowers in the loan deferral program, over 95% have continued to make on-time payments, and the modified loan cohort, over 90%. So again, all of the numbers are suggesting that these programs have worked and will prevent a wholesale batch of foreclosures. And this kind of gives you a frame of reference as to where we are in terms of foreclosure inventory and activity. In a normal year, about, go ahead.
All you have to do is ask our property teams. That's what they're dealing with when they're trying to find distressed inventory for our members.
Oh, yeah.
That's what they're looking at.
Well, they can shorten their search by looking at RealtyTrac. Sorry.
There you go.
Plug. Shameless plug.
No, we've got to get them in touch with you. Help us.
So in a normal year, about 1% of loans are in foreclosure. So we would be sitting at somewhere in the neighborhood of 500,000 properties in some stage of foreclosure this year. Today, there's about 170,000. If you go back to 2019, we were looking at about 0.6% of loans being in foreclosure, so we were at about 300,000. So even with the month-over-month increases we've seen recently, we're still running at about half of where we were in 2019, which was a fairly slow year in terms of foreclosure activity anyway. Because of the points you were making, Kathy, after the Great Recession, the criteria to get a loan jumped up pretty significantly. And so the borrowers were very well qualified. And literally the only people going into foreclosure were people who had a household financial disaster, job loss, divorce, unexpected medical bills, a death in the family, or people who got hit by a bus on the way home from work. And it just, there was nothing going into foreclosure based on the kind of loans that we saw the last time. Speaking of that, a number of the loans that are going into foreclosure again are loans that were actually issued during that bad period of time. So that cycle is a gift that keeps on giving. Some loans in New York that have been in foreclosure for 10 years now. And because of the way the state system is set up, the borrowers keep finding a loophole that continues their stay of execution, so to speak. But again, if we're speculating at Adam at RealtyTrac, it's not until late next year that we see things going back to 2019 levels. And this is one of the reasons why we talked about homeowner equity earlier, Kathy. And one of the pushbacks I got from people was, yeah, well, that's all well and good. Yeah, there's $23 trillion in equity, but I bet you people in foreclosure don't have equity. Well, guess what? 87% of the people in foreclosure today have positive equity. Over 25%, I think it's 27%, actually have more than 50% equity, and another 45% have between 20 and 50% equity. For those people, there's no reason they shouldn't be able to escape a foreclosure by conducting a traditional sale, pocketing what will probably be a fair amount of money and getting a fresh start. And if they do it early enough, they can do it without destroying their credit scores, or at least having the scores in a position where they can be rehabbed. But virtually, almost nobody in a serious negative equity position. Contrast that with the Great Recession, when 33% of all borrowers, not just borrowers in foreclosure, 33% of all borrowers had negative equity. So and this is something I do quibble with Black Knight about. They put out a report that said, well, yeah, they have equity, but historically they haven't taken advantage of it. Well, that's not really true. Even Black Knight's numbers suggested that over 60% of the people with equity who were in foreclosure did leverage that equity to get out. To me, that's not nobody's going to do it. It's most people have done it, but I think this cycle is markedly different. We have ridiculously high demand, ridiculously low supply, escalating home prices, and if I'm looking at this at all logically, better for me to exit early with, I don't know, $30,000 in my pocket and find a place to live than it is to wait another year, burn up all my equity and fees and fines, and then have to find a place to live. So part of the message I'm trying to get out, and I'll be trying to push this through the media next year, is that homeowners really need to take a look at what they have available and find out if there is a better exit for them than a foreclosure. If I had to put a number in place, and this is back of the envelope math, so don't hold me to it, but there were about 250,000 loans in foreclosure prior to the pandemic. Most of them were still outstanding when the moratorium ended. There's still about 1 million loans in forbearance. About 17% are the ones that leave without a plan. So let's say they're the most vulnerable. That would add another 170,000. We were dealing with a foreclosure rate of about 0.6% prior to the pandemic. So let's say over the next year, that would add another 300,000. If all of those loans defaulted, and if there were no duplication in those numbers, and trust me, there's a bunch of duplication in those three numbers, that'd be about 720,000 loans in foreclosure sometime in the next 12 to 18 months. And keep in mind the loans that were in foreclosure are going to re-enter at different stages. In some states, they're going to have to be restarted, so they can't pick up where they left off. And people will still be in forbearance between now and next August. So not everybody's going to exit all at once. But let's say over the next 12 to 18 months, if all this happened, and this is kind of my worst case scenario, you're looking at about 720,000 loans in foreclosure. That's about 1.4% of loans. And to put that in perspective, during the Great Recession, foreclosure rates peaked at 4%. So even if all of this went wrong and all of these loans went into foreclosure, you'd be way less than half of the peak numbers that we saw during the Great Recession. So if you're looking at the market as an investor in 2022, demand is going to continue to be strong. If you're looking to fix and flip, there'll be lots of people to buy. If you're looking to buy and rent, there will be a lot of people looking for rental properties as well. I believe most prices will continue to rise, but more slowly, partly due to rising interest rates and inflation. Foreclosure activity will increase, but probably not be back to normal levels until late next year, because among other reasons, equity is going to give distressed homeowners a chance for a softer landing. If you're a foreclosure buyer, that means you have to look at this cycle completely differently than you looked at the last cycle. Last cycle, we had so many of these borrowers underwater, a high percentage of foreclosure homes underwater as they were foreclosed on. They couldn't sell it in a traditional sale. Short sales were hard to execute. We saw a lot of those. Won't see quite as many of those this time. We'll see some. But the majority got to the auction. The majority were not sold at the auction because investors didn't want to overpay for those assets. They went back to the lenders as REO, as real estate owned, bank owned properties. And that's where most of the purchase activity took place. In this case, we're going to see the majority of these homes sell before they ever get to the auction. So you need to be reaching out to the homeowners themselves during that pre-foreclosure period, after they get that first notice, but before the property is auctioned off. My friends in the auction businesses are telling me that the properties that get as far as the trustee sale, as the sheriff's sale, they're selling at a rate of 60 to 70%, which is about twice of the normal level. So the majority are going to sell prior to the auction. The 2/3 to 3/4 that get to auction will sell at the auction. So my encouragement for you, my strong advice for you is don't wait for the buying opportunities to be the properties that go back to the banks, because they're not going to get most of those properties back this time. Kathy, that's all I got. I'm going to escape this. If anybody is interested in this, please feel free to share the presentation with them. I'm happy to send it to anybody who drops me a line. And as you know, I'm on Twitter and LinkedIn pretty regularly talking about this kind of stuff. So people can feel free to reach out to me then. But I'm going to see if I can stop sharing my screen and get this back to you. and we can carry on from
Okay.
here.
We have a few comments, and please feel free. I think we've got just 5 minutes left, so if you have questions, put them in the question section. Just one comment. Mark Vittner said in a new interview, he sees migration from the San Francisco Bay Area and California to Charlotte, Dallas, Nashville, Phoenix, and more, of course. I'm sure Austin's in there too. The exodus is accelerating, with California losing 150,000 net residents in the third quarter of 2021, larger loss than the third quarter of 2020. He says San Francisco's advantage as a tech center is evaporating. Find where these high-paid workers are moving, and you will make money in your real estate investments. Any comments on that?
That is great insight, and I've actually done a few sessions with Mark Vittner. He's
Okay.
he's great at what he does. He does follow housing for Wells Fargo. A lot of respect for his work, and I happen to agree with everything he wrote and everything our participant put in place. Boise has become, as I mentioned earlier, kind of a satellite tech hub. St. George, Utah did. Salt Lake City already was, and St. George is close to Salt Lake City. So Arizona, Reno is growing like gangbusters. Tennessee, Nashville has been growing. Charlotte is a tech hub. So when the Mark Zuckerbergs of the world say that maybe we don't need everybody working in Silicon Valley. Maybe we can do this with satellite offices or work from home environments. I think you're going to see more and more of that. And yeah, I mean, if you don't have to live, don't have to live in a market as expensive as the Bay Area and have a horrible commute into your office. A lot of people are just going to choose not to. And this is the first time in decades that California's had a net out migration larger than the number of people moving in. And so it'll be interesting to see how the state holds up over time as these high-paying tech jobs and tech companies exit.
Yeah. Okay. Todd said great data. Someone said, Rick, sorry, I joined late. Boy, I need my glasses. So please forgive me if you were talking about that when you talk about equity. Do we take HELOCs into equation? I'm a realtor here in Tampa, and I see a lot of HELOCs recently taken by the owners.
Yeah, it's a good question. The short answer is yes, because typically something related to the house is encumbered with those HELOCs. So if you're going to be buying these properties, you're going to probably have to factor that into the total equity amount. If nothing else, the person selling the house is going to want to get whatever balance on the HELOC covered when they sell the property. They don't want to carry that with them if they leave. And that's equally true on foreclosure properties. One of the things you'll notice on sites like ours is we'll have multiple loans if they're still active in the public record with the positions of the loan. So one of the things you want to be careful about if you happen to be at an auction buying a property, make sure, I've seen people make this mistake over and over again. Make sure you're not buying the second loan. Make sure you're not buying a HELOC. Because then the lender can foreclose on the first loan, you get wiped out. But yeah, factor that in to your numbers when you're looking at buying a property. By the way, there have been surprisingly few HELOCs over the last 5 years. Lenders have kind of moved out of that business, and we've seen equity sharing companies spring up to fill that void. Non-traditional lenders spring up to fill that void. And we're seeing an increasing number of cash out refis being done instead of HELOCs. So keep those kind of loan products in mind too as you're analyzing these properties.
Does it look unhealthy in terms of the number of cash out refis? Because they still have, it's nothing like before where you could go 110% over value or something on the cash out.
See, that's why I love you, because you know this stuff. You'd be stunned how many people. No, everybody keeps pointing back at the last crisis and saying, "Oh, it was the subprime loans." Like, no, that was part of it. Yeah. If you really look at it historically now, the loans that defaulted the most were cash out refis, and it was people using their house as an ATM. My wife used to comment, we'd be driving home and there'd be a new boat in the neighbor's driveway, and we'd see the box out from an 80-inch plasma screen TV. And she'd be saying, same neighborhood, same neighbors, how can they afford this? And I said, they can't. This is going to be a problem. And sure enough, several months later, they were in the RealtyTrac database in foreclosure. And it was all cash out refis that were, unwisely spent. So no, the lenders are, again, being pretty rigid in what they're allowing in terms of cash out refis. We will see them as a higher percentage of refi volume next year, but that's mostly because rate-based refis will go down as interest rates go up. So no, the lending industry has been pretty diligent about minding their P's and Q's this time. And boy, if that's not an expression that makes me sound old, I don't know what is. I think that was created by the Phoenicians. That's how the P's came to minding your P's and Q's. But anyway.
All right. How does mass corporate hedge fund purchases of rental homes affect the outlook for investors and others?
I love
We were
these
just
questions.
at IMN together a few weeks ago talking about this with all the top hedge fund managers. So we just learned some stuff. What did you learn at the IMN?
Well, I'm not going to ask you what you learned, but I will tell you that the reason I like answering this question is because it flies in the face of math. Again, now I'm a letters guy, not a numbers guy, but when you look at every publicly published report, and this is from the REITs that have gone public, this is Freddie Mac information, this is all over the place. The institutions collectively own 2% of the single family rental stock. Are they buying opportunistically when somebody says, hey, I have a property for you to buy? Yes, they are. Would they like to buy more? Yes, they would. Are they the ones driving all the sales? No, they are absolutely not. So it's an urban legend that won't die. It's the crocodile, the giant crocodile in the New York sewers. But I'm still not seeing it. I'm seeing mostly trades. So, an institutional investor says, I don't want to be in Pocatello anymore. I'd much rather be in Memphis. And they'll sell off assets in one area and they'll buy assets in another area. But Kathy, am I missing this? Am I missing the stealth buying going on by the huge hedge funds? Is Wall Street gobbling up Main Street faster than I think it is?
Some people who are out there bidding are saying that. And, I talk to so many people and I hear so many different stories. At the IMN conference, I talked to a total data head. I won't say his name, but he has created and sold websites that track data. And he said, oh, the foreclosures are ticking up. We're seeing it already. It's going to be just a flood of them. And I'm like, this is not where I'm not seeing it. Just from a complete, if I don't look at data at all, it's just my gut. It's like banks don't like foreclosing anymore. They really learned that was not good for the underlying asset. It wasn't good for them. They don't want to do it. They started loan modifying 10 years ago to just stop it and kept people just living there, or went into the rental business. Like, they don't want to flood the market with foreclosures. So just from that perspective, I don't see it happening. But
do you see Invitation Homes and American Homes for Rent and Starwood, doubling, tripling the size of their portfolios of single family rental properties?
They want to. I think they want to, and they talked about that, but they're facing the same issues we're facing. So that's why a lot of the conference that we went to, it's no longer about buying existing homes. They're building them. They're trying to build them.
So that trend I see, the build to rent trend, I do see, and some of the bigger players that partner with some of the bigger builders, and you can make an argument there. But the people who respond to our quarterly survey are your traditional mom and pop investors. They're buying 1 to 10 properties a year, and they have cited competition with traditional home buyers as more of an issue in their markets than competition with institutional investors. So that tells me something. If you're not competing with Blackstone, you're competing with Joe and Mary Black. That tells me that the institutions have not been able to kind of gobble up the inventory they'd like. So I don't see it. It's not in our numbers. Not what we're seeing in field surveys. Maybe it's going on, but it's not obvious if it is.
Yeah. All right, well, we are at the hour and we have no more questions. So Rick, thank you so much for sharing this data and information. And every time I just think, oh my gosh, I got to get out there and buy if we could just find some property. By the way, I want to let our audience know that there are 2 multifamily they might be sold already, but there are 2 properties in Tampa that came on the market. I'm telling you, this stuff sells so fast. I don't know if it's still there, but call your Real Wealth investment counselor right away if you're looking for, I think it's a 3-unit or something, 3 units in Tampa. And yeah, so if you want it for year end to get the tax deductions, be sure to call your investment counselor at Real Wealth to find out about that. We also have lots still available in our Park City subdivision, which I think is a great deal because they can't get built. We can't build these homes fast enough. So you can just buy the lot and build it next year. And my goodness, then I think there'll be a whole lot of equity in that. So anyway, Rick, thank you so much again. And I look forward to I think you said you would come back more often and keep us updated. So we will make sure that happens.
We ought to set a day quarterly and do that. Merry Christmas, happy holidays to you and your family, and to everybody who joined us today. And best wishes to everybody for successful investing in 22.
Thank you. All right, take care, everyone. Bye-bye. Happy holidays.